This year, we're going to want to pay very close attention to rates. A lot of people are talking about how they're going to continue to fall. We have a new Fed chair showing up later this year as well. And so this is going to be absolutely key for us to pay attention to. Now, today we're taking a look at the 30-year bond market. We're going back 2 decades on a monthly chart. And you can see we had an uptrend that was in place until about 2021. We broke below that uptrend for the first time in a couple of decades. And since that point in time, we fell all the way down to the major level of support from 20 years ago. And that was in 2023. And since then, we have put in a series of higher lows and lower highs. So the 30-year is making a wedge at this point in time. And we don't have clarity in terms of whether we're going to break up, stay inside this range, or break down. But this is something we're going to absolutely want to pay very close attention to. A breakout here on the 30-year bond would mean rates were falling. That would be a very positive sign for the mortgage market, the housing market, and that would be a good sign for anybody that wants to borrow capital. If we continue to stay inside this range, we're basically where we've been at for the last couple of years. That doesn't really give a big difference in terms of borrowing power or help the housing market whatsoever. And if we were to break down, which this doesn't really look like that's going to be the case because we did find that multi-decade level of support. But if we were to break down, that would mean that rates were back up on the rise. That would probably mean we have an inflationary problem, and that's not something that we're really seeing in the fundamentals at this moment. But this chart is absolutely key to pay attention to as we move through the course of the year. We will keep you posted because it's going to have profound implications if we do leave this range to the upside.